What is up, Empire Builders? Before we jump into this video, I wanted to quickly show you that we are running an exclusive Empire merch drop till the end of September. That's right, only until the end of September we are going to just run the classic black with white logo so that you can go ahead and rep Empire to the fullest, okay? These shirts are going to be $23.99, but free shipping code is going to be underneath this video. It is just Empire, all caps. That's Empire, gives you free shipping. That's $4 off. You're paying about 20 bucks for the t-shirt. I think that's fair. Most other merch and Teespring gigs are not that cheap. They're usually $24 to $35. And so I want to make sure this is affordable. You get it and absolutely represent the community here. So if you want to go ahead and take advantage of that, the link will be underneath this video and there will be the discount code as well. Thanks. What is up, Empire Builders? Jameson here from Empire Research, and let's go through episode 6 of Weekend Reads. So, I don't know what I was going to say there, but we've been going now for the last 6 weeks doing a recap at the end of the week of the emails that we send out for that week. If you just want a quick catch up on what's going on at the macro level, or maybe you didn't get to read all the emails, maybe you don't understand them, maybe you want to hear me talk through them, those are all reasons why you'd watch this video. If you enjoy this, then just take a second, click the like button, and of course, as we go through this, if you've got something that comes to mind, then comment below. Okay, so let's dive in. We started out Monday with the August job numbers. For the month, they were down a little bit. They were shooting for an expected, I heard anywhere between 150,000 to 160,000, depending on the poll. Dow Jones poll was, they were looking for 150,000 new jobs. They ended up with 130,000 new jobs. Not bad, but of course, it's Trump, so everything is used as a reason why this guy sucks and we should impeach him and get him out of there. Retail trade went down in terms of job numbers, which makes total sense. We continue to see this pivot. We continue to track this situation going on where a lot of retail is having to pivot to e-commerce, and e-commerce is taking over. We have Amazon that is completely taking over. So that retail number should continue to suck, okay? Overall, there is a slowdown of job growth in comparison to last year. Last year overall, I mean, you can't really complain, especially through December when there was the government shutdown. I mean, there's a lot of really great things going on still last year. And we've seen some lower numbers this year, 56,000 and 62,000. It is hard to keep that up, though. I mean, that's why we're not the president, or never could be, nor want to be. Okay, so that was it for the job numbers. Let's now pivot into something that Jerome Powell said, which I thought was interesting. Been covering this whole topic of like the bankers can't save the people kind of thing, and we covered it back in July about talking about like there's these new central banking TV shows, one for England, one here in the United States, and there's like this recent PR that happened through July, a little bit happened in August, and now September, which is it's almost like the same thing, but it's saying that we cannot be expected to save the economy by ourselves. It's a version of that. And so what's far more interesting is that through all this drama going on with the White House and the Fed is literally they threw, I don't know if this is like the guy just wasn't thinking clearly or maybe he just doesn't care. I don't think I've ever heard a Fed chair admit this, but this to me is a huge thing. Jerome Powell admitted in his speech that we are not part of the government. He literally said, we are not part of the government. That is so big because it's going to get people to start questioning, like normies, as they call them, to start questioning, well, wait a second, I thought they were. So who are they? So who owns them? Right? Like logical, basic questions. And that is going to start this path of red pilling a lot of normal people who had no clue this was going on. Okay? So I thought that was really, really cool. But that seems to be another piece down this road of this PR angle that is creating this separation, right, between the central banks and the government and then the people. Okay, here's some other sound bites from the speech. We're not expecting or forecasting a recession for the United States. Our projections are still projecting moderate growth. strong labor market, and inflation continuing to move back up. Our obligation is to use our tools to support the economy, and that's what we'll continue to do. I think it is the case that uncertainty around trade policy is causing some companies to hold back now on investment. Okay, yeah, so that was it for Monday. I was just reading the rest to make sure I didn't miss anything. Tuesday, this actually launched on Monday, but JP Morgan launched what they are calling the Vol-Fifi Trump Index. I believe I shot a video on this talking about the details of this, but apparently there was some tweet that happened about a year ago from Trump that was like just after midnight, and it was some sort of incoherency jargon. Nobody knows, but it was, I can't remember the exact full sentence, but it was just a short sentence, and they ended it with co-fifi. So this was kind of like a joke. It was like a play on words. But it is pretty interesting to go through the data itself. The impact of tweets about China seem to be wearing out. They seem to be, dropping a little bit in their power. But he did have some tweets that moved the market 9 base points. Okay, so Bank of America Merrill Lynch found that on days Trump posted more than 35 tweets, or in the 90th percentile of the markets, tended to fall 9 base points. Okay, so that's separate data. This is the JP Morgan index. Okay, they basically just created a script that analyzed more than 10,000 tweets from this repository or archive site, and they measured it for words. They cross-referenced it against the S&P and the Dow that day, and they just came up with some data sets, which I thought was really, really cool because, I'm a data junkie. So at the top of the list, we see China and billions and products and Democrats and great and dollars and tariffs are all right there in the beginning. These are the most used words, okay? All right, next. This was the more important one that I wanted to talk about, is that market-moving tweets. Well, out of the 10,000 or 14,000 tweets he's had, there's been 146 that essentially moved the market in some sort of way, okay? Which is, I think, less than 1%. Well, it's just about 1%. Okay, yeah. So that's that. His engagement is going down as time has gone on. And he's continued to use Twitter as a sort of platform to go around the media, which I do like in a lot of ways. Like, remember back when the president kind of had to set up these interviews and it took so much time to get data to people. I do like the fact that the data now is like instantaneously sent and out to everyone else. I think people still aren't really used to that, but it is something here. I don't think it's going anywhere, that ability to instantaneously send out a message. It might not be Twitter that's the platform that lasts, but I do believe that for now is here to stay. Okay, so it appears that Trump sleeps from 5 a.m. to 10 a.m., which is a very odd sleep schedule and just proves that this guy hustles his face off all day long. He does have some points of the day where he tweets the most, and this is based on year, so we got blue is what I'm looking at the most here because that's this year. But he's mostly tweeting between the 12 and 2 p.m. times, okay? And then he also has a spurt around 3 a.m., okay? So he's got a good amount at the 3 a.m. time frame, okay? Anyways, that was it. You can go through this email. You can go through the data even more, okay? Also, too, this week we published 3 indicators showing that the U.S. dollar will lose its global reserve status. So you can check that out. These articles, too, like just to show you really quick, they're not short. They're pretty long, in depth. You see all those blue spots? All those blue spots are links. So I don't do sources at the bottom because I just thought that'd get annoying because there could be so many. I just link in the article itself, which is what most, I guess, journalistic sites do. I don't think I'd consider us journalists, but we are definitely reporting on what's going on and giving our opinion and showing what the data is pointing out. Okay, Wednesday, the next big short. Michael Burry is back in the news lately talking about what he believes to be the next big short, which is ETFs. So these robo traders, this rounding up of a lot of different stocks into one index. These indexes are bloated. These indexes are a lazy vehicle used to invest. And here we have the best indicator of that. Again, Bank of America Merrill Lynch, showing you passive and active investing, which it's definitely passive, these robo-advisor ETF indexes, okay? And we're going to see this crossing point really start to happen after 2022. So I don't know if there'll be dramatic changes that happen between now and then, but what it's looking like for right now is that there's going to be a crossing. Okay, so here's what he had to say. Passive investments such as index funds and exchange-traded funds, ETFs, are inflating stock and bond prices in a similar way that collateralized debt obligations, CDOs, did for subprime mortgages more than 10 years ago, which CDOs never went away, by the way. They renamed it something else. It was something tranches, and it was just a fancy name for basically a CDO. Let's also not forget that in 2009 financial crisis, one person was arrested. Okay, when a massive inflows into passive vehicles reverse, it will be ugly, he said. Like most bubbles, the longer it goes on, the worse the crash will be. This is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis, and the price setting in that market was not done by fundamental security level analysis, but by massive capital flows based on Noble-approved models of risk that proved to be untrue. So he's just basically saying a bunch of people who don't know better, not fundamentals, drove up that price. Same thing's happening here. Trillions of dollars in assets globally are indexed to these stocks. The theater keeps going. The theater keeps getting more crowded, but the exit door is the same as it always was. Yeah. So, anyways, the thing I added at the bottom and talked about is that even though we have him coming out, and I think he's a trusted source because he was like the first one to nail the subprime mortgage and go to the banks and actually have them create a specific vehicle just for him to bet against the subprime mortgage, which he got laughed at time and time again. They thought he was crazy and stupid, but of course they took his money and he was right in the end, and they called him up with their tail between the legs at the end. But what I talk about at the bottom is that let's not forget the 100-year chart, okay? And this is on a weekly, by the way. And we have all these things coming up, which I talk about more and more. And I shot a video about that called There Is No 2020 Recession, which is clickbait. But I do present both sides of the idea, which is I give all the reasons why we would see a recession, and then I give the reasons why we might not see a recession. So it's basically just kind of a play on words for the title to get people to click on it, and I present both sides of the story. So it's not a super biased, opinionated piece. I think it's still fairly objective. Okay, so yeah, so I just show again, like, look, this was the 2009 financial crisis right here. This was the government shutdown in December here. This line doesn't have to hold, by the way, but even with these big, 57-ish% setbacks, I don't know what this one was, way less than that. But, we could see something like that again, but the chart is still going up. And that was the simple point of that. Okay. So Thursday, maxed out on credit card debt. Oh yeah, and I recovered this in the 2020 recession video. But here we go. We got some stats on the United States. Checking back in on this. It's been a while since we talked about this. I covered this extensively in the Global Reset Report, which was a almost 60-page report that the premium members all got access to. Amazing amount of data. Literally every single chart, graph, data point I could possibly find. I was compiling that report for 6 months. Okay, so if you ever want sources and links, well, then you can pay for it. Okay, so here we go. Total U.S. debt, including all forms of government, state, local, financial, and entitlement liabilities, comes close to 2,000% GDP, according to A.B. Bernstein. The biggest potential load comes from entitlements like retirement, etc., but is being pressured from rising levels of federal government debt as well. The warnings about potential debt hazards comes as total federal debt outstanding has surged to $22.5 trillion. Okay, the federal deficit surpassed $1 trillion in the first 11 months of 2019, according to the CBO, or Congressional Budget Office. The national debt is now more than 10x the annual tax receipts. The average credit card interest rate as of September 11th was 17.61, which is pretty high. Okay, so the deficit number, understand that by the end of this month, September, we will have quarterly tax payments made. So it's not like that'll save that, but it'll probably bring us right back down just below 1 trillion. We're ahead apparently by 168 billion from the same time last year, just for reference. Oh yeah, yeah. So auto loan delinquency 90 days or more is up. Technically up, especially since we bottomed out essentially back here in middle of 2014. But we are still gradually going up and pretty close to all-time highs, which we saw in 2009 and 2010 when the financial crisis hit. So these numbers will go up as housing crisis or a recession comes in. You look for these numbers to spike, so you don't want to see this. The bad news is that we've got one of the biggest U.S. subprime auto finance companies. So they are a company that provides auto financing, but they use it. It's a subprime company. Okay, so they mix a bunch of this stuff together, A, B, C, D, E. Well, it turns out that they've only been verifying income on less than 3% of borrowers. I have no clue how this has been published as public knowledge, but yet they're not being investigated in any sort of way. Maybe they are. I hope so. But that is a very low number, especially in comparison to AmeriCredit, which does GM financials. Okay, and they verify about 68%. Less than 3%. That's about as bad as what we saw during the subprime mortgage crisis around the 2009 financial crisis. Okay, and this company has now bundled more than $1 billion worth of bonds and sold it this year, according to Moody's. That's bad. But it is a little bit worse in Canada, okay? Right now, the number of Canadians who are $200 or less away from financial insolvency every month has climbed to 48% in Q2. 35% of Canadians say interest rate increases would move them towards bankruptcy. Yuck. And 54% said they worry about their ability to repay debts. So that's not good. This is an interesting piece. We're now seeing Donald Trump, the president, trying to further dictate over the Federal Reserve and suggesting now negative interest rates, which we've never seen a president ever before ask for negative interest rates. I've been consistently reporting on how bad this has been for Japan and the EU. I don't think it's going to be a good thing for the United States. So unless there's something huge I'm missing, which I'm okay with, I do not see this being a good thing. If this is some temporary idea to avert some sort of recession we were already heading towards, which I could see that, I don't know, and it's not being very well communicated at all. But it would appear that now we're starting to have this talk of negative interest rates, which the United States has never had. I don't think they're going to take to it too well. This tweet didn't get great response, and of course everyone's jumping on them again. But that leads us to Friday the 13th, full moon day, harvest moon day. So very weird day. Yesterday a lot of people were strange. But ECB rolls out next round of QE. Yay! QE, everyone loves that. Quantitative easing is a fancy word for saying we're going to print the shit out of a lot of money and pump it out into the economy in hopes that it will do good. And it doesn't usually do good, okay? This was an original idea by Ben Bernanke, your national hero from 2008. He started this in 2008, around the time of the financial crisis, okay? All right, so it's interesting to look at the EU. They've been manipulating rates and manipulating monetary policy for the last 20 years. Where's it really gotten them? It's just recession after recession after recession. I mean, think about that. So here's what Goldman was looking at ahead of the 13th. So this was on the 12th. They released this. What they were thinking they were going to do was a medium. Look at this. And that was a comprehensive easing package. That just, I don't know. It just sounds so weird when you wrap it in words like that. It's not a package. It's the future of the country. But sure, okay, it's a package. So they were thinking negative 20 base rate points, reserve tiering, stronger forward guidance, blah, blah, blah. Some changes to corporate purchases, sovereign purchases. Okay. And then I basically just copied in what the ECB ended up releasing. And they decided that they would decrease by 10 basis points to minus 0.50%. The interest rate on the main refinancing operations and the rate on the marginal lending facility will remain unchanged at the current level of 0 and 0.25% respectively, so 0.25%. Government and Council now expects the key ECB interest rates to remain at their present or lower levels until it has seen the inflation outlook robustly converge to a level sufficiently close to but below 2% within its projection horizon, and such convergence has been consistently reflected in underlying inflation dynamics. Until, wow, what that says is until it turns around, that sticks. Yeah, so interesting 5-point rollout. So Draghi, the current ECB head, which is about to be replaced by Christine Lagarde, he's under heat because France, Germany, Dutch, they all opposed the QE. Okay, they didn't want it. But why do they do this? It just, regular rational thinking people like you and me, we look at something like this and we're just like, gosh, why are they doing this? This is absolutely retarded. This is the only solution they've come up with in the last 20 years. Why wouldn't we have just tried anything else up until this point? Well, here's why. Euro area banks paid 23 billion euros to the ECB since negative rates were first introduced in 2014. Furthermore, Germany estimates that since 2012, German savers have lost over $150 billion. So, what is this? This is theft. This is theft of purchasing power of the people. That is the point of this. If there's one thing you take away from all this, negative interest rates and quantitative easing, it dilutes purchasing power and steals your money. So the banks get on TV and they play stupid and, oh my God, we're trying and the recession and we don't know what's going on, and they play stupid there, but they play super smart with the policy that they roll out. So they play both sides of the coin. And I wrap up here with saying that, once again, they basically come out and they keep making these statements. Monetary policy, central banks will not be able to carry the load. We can't save everybody. And they keep pushing that, right? And that's part of the plan here to create separation, is that they come out and kind of play dumb in some aspects so everyone thinks that maybe they've just gotten by luck. But then with their policy changes, they know exactly what they're doing. They're stealing money from you and me and our friends in the EU or the Eurozone, okay? And they just continue to do it over and over and over and over again. So that's why I'm confused at why we would go negative interest rates in the United States, because it would further dilute purchasing power. And it just, I guess, until we find out, it further proves the point that you should be picking up metals and probably getting into Bitcoin as well. And other things, sovereignty protectors like cash flow businesses, etc., which I talk about all the time now, and I'm constantly referencing to keep it in your mind. But that was it, my friends. That was the full week up till Friday. Yesterday, I released a bonus audio. So again, if you subscribe, you get these things. I don't talk about these audios at all here, but they're like mini podcasts, just kind of thoughts and fuel and fire for you on your entrepreneurial journey, let's call it, on your journey to create more sovereignty and build your empire. That's all I got for you, my friends. If you got something to say, comment below. You like this video, just want to support us, click the thumbs up button, okay? And subscribe, hit the bell notification so that you don't miss out on any updates. Now, you probably still will miss out on a lot of updates. It's just how it is right now. I got a solution for you. When you first come to the site, there's going to be this little thing that pops up here and it says, do you want notifications? You see that on a lot of sites now, and I know you're used to clicking block and clicking no, but if you click yes, then what you'll get is you'll just get a notification over here in the right-hand corner when we post 3 things: articles, videos, and emails. Now, if you're already subscribed to emails, then that's fine. You're already going to get that anyways. It's just a reminder. And then, since most people aren't getting the notifications from YouTube, you'll get that here. It'll show up on your desktop, and pretty non-evasive, pretty relaxed, message. We're not going to overdo it. We just want to make sure that you guys are getting notified of everything that we're doing in those 3 key areas. All right, my friends, that's it. See ya.